There are 7 ways to reduce your taxes legally that nobody is really talking about. So in today's video, I'm going to show you 7 things that you can do to save at least $10,000 in taxes in 2025. And the best part is, you're probably doing some of these things already, you just didn't know how to deduct it on your taxes. The first way is actually as simple as just making sure that you are in the correct tax entity. Just by doing this, you can save thousands of dollars in taxes each and every year. The first way to pay less in taxes is simply by making sure that your LLC is taxed as an S Corp. Just by making that election, you can save thousands of dollars each and every year. Later in this video, I'll show you the perfect time to make that switch. And that's just one of the ways that we've helped hundreds of clients save thousands of dollars over the last 10 years. In fact, we saved this particular client that you can see on the screen. When they originally came to us, they were about ready to pay almost $35,000. However, after working with us, they went to owing a little bit over $16,000. Pretty good ROI if you ask me. Now, if you want to work directly with us and have us help you save $10,000 in taxes, click the link in the description of this video, apply to work with us, and we'll get you on the straight and narrow. Without further ado, let's go ahead and jump into today's video. The 7 things that you want to do to help reduce your taxes by at least $10,000 are as follows. Number 1, you want to make sure that your business has made the correct tax election. We'll go into that. Number 2, you want to leverage your health savings account. Number 3, you want to hire your family strategically. Now, most of you have already been doing this, but we'll get back to that later in the video. Number 4, you want to make sure that you're taking advantage of the Augusta rule every year on your taxes, and believe it or not, you're probably already doing this. 5 is one of my favorite. You want to make sure that you're maximizing your retirement contributions, and actually I lied, number 6 and 7, those are my favorite. Optimizing your business meals and unlocking tax-deductible business travel, one of my favorite things to do. Now, before we jump into detail about all the 7 strategies that we want to implement this year, we have to really know 2 things. And these are super important, and there really are a lot of confusion surrounding these. First, we have to know what exactly is an LLC. Because if we don't know what that is and what the purpose is, then we're going to be completely lost when it comes to tax strategies and what you can do. Number 2, we have to know also what exactly is a tax deduction. A lot of these terms are bastardized or not explained very well, so I want to go into depth what these 2 things are, and then we can go ahead and discuss how you're going to reduce your taxes by $10,000. Now, what exactly is a limited liability company? It's kind of what the name implies. It limits your liability. It doesn't have anything to do with taxes. Now, I know that most people think when they open up an LLC, the taxes or tax strategies, tax deductions, they just rain down and you become this tax strategy machine. That actually has nothing to do with it. It limits your liability. Now, what do I mean by that? Let's take me, for example. I own a tax and accounting firm and I do people's taxes. If for some reason I typed on somebody's tax return that they made $1 million instead of $100,000 and I added another zero, they could sue me, right? However, I have an LLC, P&T Advisors LLC, that protects me. That means that client, if I made a mistake, they would sue my business and only be able to take my business assets like my computer, the cash in the bank, supplies like this pen, this microphone. They could not come after me personally and take my car, my home, any other things that I have. That's all an LLC does. It has nothing to do with tax deductions or reducing your taxes. Another term that is really misused a ton is tax deductions. Now, this is straight from the IRS's site. A deduction is an amount that you subtract from your income when you file so you don't pay tax on it. However, that's kind of vague and I don't really like that description. A better way to describe it is tax deductions for business owners, they're legitimate expenses that you have from running your business. So think renting an office, kind of like I have here where I'm shooting this video, software subscriptions, office supplies, right? Things that you need to buy in order to make money. And again, these have to be legitimate business deductions, not something like the strip club or going with your friends to a water park or anything like that. It's really, if you can tie a business reason to why you needed to do that to make money, then it's a business deduction. Now, let's see how these deductions actually work in real time, because this is another misnomer that people think if I spend $1, I save $1 in taxes. That's actually not how it works. So we're going to take 2 examples here. Let's take this first one here at the top. Let's take somebody who has a W-2 salary, meaning that you work for somebody else. If you make $100,000 and your tax rate is 20%, you owe $20,000 in taxes. Pretty simple to understand there. The business owner taxes are a little bit different. Now, I'm going to use a simplified version. Let's take the business owner, right? Same income that they make, right? So, I made $100,000 last year from preparing tax return and selling tax services. However, I incurred $20,000 in expenses, just like I talked about above or in the other slide. I have to pay for rent, I have to pay for supplies, I have to pay for software, all this other stuff. After paying for all of my business expenses that I incur, I'm left over with $80,000. If I'm taxed at 20%, I owe $16,000 in taxes. So as you guys can see here, for every dollar that you spend, you get to save your tax rate in taxes. You want to think of it as a coupon or a discount, not a complete write-off. And I think that's where the term gets grossly misused. But now that you guys understand taxes, understand deductions, let's get into how you can actually reduce your taxes this year. The first thing that you want to do is you want to make sure that you are in the correct tax entity. When you are a business owner in the US, you pay inherently three types of taxes. The first one you're going to pay is what's called your federal tax to the federal government. That pays for things like the Army, the interstate, and anything on a national level, or the IRS too. The second one you're going to have is what is called your state income tax. You pay taxes to the state that you live in. For example, I live here in Iowa. I pay taxes each and every year to the state of Iowa. Some states don't have tax, like Texas, Nevada, Florida, South Dakota, and a few others. The third type of tax, which is how we're going to get to here, is what's called the self-employment tax, which is roughly 15% of your net income. Think of the example that we had up there above. When you are self-employed, you pay your own Social Security and Medicare. When you are an employee, you pay half of that that's withheld in your check, which is about 7.5 or 7.65%, and then your employer pays the other portion. However, when you are self-employed or you work for yourself, you have to pay both sides, which is roughly 15%. However, when I talk about making sure that you are in the correct tax entity, if you elect your LLC to be taxed as an S corp, you can lower that self-employment tax by being an S corp. What that means is that you get to eliminate a portion of that, and you really get to save probably somewhere in the neighborhood of 10% of your income in taxes, which is a pretty powerful tax deduction. However, it's not for everybody, and I don't go willy-nilly recommending it. While electing to be taxed as an S corp is great, there really are some pretty strict guidelines that we abide by at our firm before we start recommending this to people. Number one, you have to be making $90,000 in profit as a business. The reason for that is you are inherently going to pick up a lot of administrative costs. For example, you have to file a separate business tax return. When you are a normal LLC or a single member LLC, it goes on your personal return. But now you have a second tax return. Number two, you have to give yourself a payroll check. That means you have to issue yourself a W-2 and most likely hire out a payroll processor to do it for you, which can run anywhere from $500 to $1,000 a year. Third, your bookkeeping is in record keeping, it's going to become inherently more complicated, which means you have to spend more time on it or most likely hire another accountant to do your books throughout the year. So while that 10 to 15% in savings is great off of your profit, it really gets eaten up by a ton of administrative costs really, really quickly. So we want to make sure that you're profitable. Number two, you have to be organized. And what I mean by that is you have to have things like separate bank accounts. You have to be willing to do payroll. You have to be an organized person. And if you're not organized, this is really not for you because now you have two tax returns that are due at two separate times throughout the year. Not ideal if you're unorganized. And number three, you want to be able to follow direction. Now, what I mean by that is at our firm, when we have people become an S corp, we work with them for at least 1 year after that, holding their hand, making sure that they're doing what we say. Whether that means setting up an S corp, reimbursing yourself different for your home office. You have to be able to follow direction, and we want to make sure that you can do that too. However, if you're not in those three, again, making at least $90,000 in profit, that you are organized, then an S corp really isn't for you. Now, as we go down here, who it's not for, obviously unorganized business owners, what I just talked about, but you want to be organized. Number two, though, this is really important and it often gets overlooked, which is why you want to work with a professional, because there are a ton of nuances. Certain locations around the country, it's not ideal for an S corp. For example, New York City, Tennessee, and a few other states and locales. What I mean by that is, well, sure, you could probably say somewhere around 10%, on your self-employment tax if you elect to become an S corp. However, certain states and locales tax you extra. For example, Tennessee does not have any state tax. But if you start an S corp or elect to be taxed as an S corp, I believe you add yourself a 7% tax. It's an excise or franchise tax. So I don't know if you want to pick up all of these extra costs just to save 3% taxes. It doesn't really make sense. And New York City is similar. They also tax S corps in a very similar fashion. So if you're saving 10%, but you pick up another 5 to 6% tax, this really doesn't make any sense. So again, it's really important to work with somebody or work with an accountant that understands this and knows how to ask these questions. The second strategy that I want you guys to implement this year after the S Corp is I want you guys to start contributing to a health savings account. The way that that works is very similar to an expense. Let's say that you make $100,000 a year and you want to contribute money to an HSA, you get to chop that off the top. In 2025, if you're single, you get to deduct or contribute 4,300. If you're married or have a family, it's 8,550. And if you're over 55, add $1,000 to each of those. And it works very similar to the deductions for the office and the supplies that I talked about earlier in the video. If you make $100,000 and you contribute 4,300, you get to take that off the top. Now, one of the reasons why I like this so much is that it inherently lowers three types of taxes: your federal tax, your state tax, and your self-employment tax. I love that when you can knock out all three. Now, the second one here, that you can invest the funds and they can grow tax-free. Now, what does that mean? If you put $4,300 into a savings account or a health savings account, that money can grow forever, or at least until you die, I guess. It can grow in the stock market each and every year. Now, most of us are already doing something like this. Think of this as like an emergency fund, right? We should all be putting money away into an emergency fund. However, just a general emergency fund isn't deductible. However, if you are putting this in a medical emergency fund, it now is deductible, something that you were going to do already, and that money has a chance to grow. I love for people to do this because you can never take your health too seriously, and it makes sense to be able to do this. Now, there really are only three things that you really need to have in order to be able to qualify and open up one of these accounts. One, you have to be covered by a high deductible health plan, which is generally $10,000. What that means is that a high deductible health plan means you're going to pay more out of pocket, but you might have lower costs on your premiums each and every month. Think things like physicals, blood work, lab work, prescriptions. You have to pay for that out of pocket. Your insurance doesn't. Number two, you cannot be on Medicare, which for most of us watching this video, you're most likely not on that. And number three, you cannot be claimed as a dependent on somebody else's tax return. So if you still live at home with mom and dad and they deduct you or claim you on your taxes, you are not eligible for this. But I really like this one because you get to take the money out tax-free as long as you are using it on medical expenses that you incur. I really love this and I encourage everybody to contribute to these. The third thing that I want you to do, and this is most likely something that you are already doing if you're a business owner, you just didn't know it. You want to be able to hire your children to work in your business. The reason why I like that is, as you saw in the example earlier in the video, if you make $100,000, you're taxed in the 20% bracket. And again, I'm just using that as an example. However, if you pay your child, let's say $2,000 a year to work inside of your business, now you get to deduct that on your taxes and you move that income to a 0% bracket because most likely your child is going to earn too little money to have to file or pay taxes. The reason why I like that is, number one, you're already going to spend money on your kid, whether it's through Little League, through private school, through food, through entertainment. You're already spending money. Let's just change the way that we pay for that stuff. Now, one thing that I want to impress upon, and later in the video you're going to hear me say it again, is that you have to take this serious and you have to treat them like a normal hire. Now, what that means is, if you are going to hire your child to work in your business, for example, instead of doing chores, they might be your office assistant or clean your office. Or, for example, they could help you set up this camera that I'm filming on. When I have kids or if I have kids, I would have them set this up for me and I can pay them to do it. Now, again, you have to treat them like a normal hire. What that means is, if you're going to hire a videographer, for say, right, you're going to have things like a contract. You're going to sign an agreement. And most importantly, you're going to pay them a market rate. When you hire your kids to work with you, it has to be at a market rate. I can't just arbitrarily say that I'm going to pay my 6-year-old $100,000 a year because they need to be my office assistant. That's ridiculous. You wouldn't pay Susie's kid or a non-related kid $100,000, so they have to pay them a market rate. Same thing with hiring a videographer. If somebody charges $1,000 a month to be a videographer, you're not going to arbitrarily pay them $5,000 just because you like them. No, you're going to pay them what it is. And lastly, you have to issue them W-2s. This is super important. If you're going to hire an employee in business in January, they're going to ask you, hey, where's my W-2? Where's all my withholdings? They're going to ask for that. Same thing with your child. You have to treat them like a real employee. Again, contracts, pay them, W-2s. We have to do these things. Now, I want to stress upon this enough because social media makes it seem like you can just hire your kid and do whatever you want. This is for serious business owners only. And they're organized, kind of like the S Corp thing that I talked about. You have to be organized. We all know that one friend who's not going to do it, who can't show up on time. You're not going to give them complicated instructions. Same thing here. And again, it's for people who do not want to bend the rules. I'm all about paying less in taxes and using the tax code to your advantage and writing things off and deducting them. However, we all know people who want to write off their Rolexes, their clothes, and there are plenty of IRS court cases where people lose those deductions. We want to make sure that you are doing this legally and be able to survive an IRS audit should this happen. The fourth thing that you're going to do this year on your taxes is if you are a homeowner, you are going to rent your personal residence 14 times per year to your business. In order to do the Augusta rule, right, it has to be legitimate. Like I talked about with your kids, market rates, it's going to be a very common theme here. Number one, before you rent your home to yourself or to your business, you have to think of it, what would you do if you were going to rent this home to a stranger? Well, you're going to find the market rate, right? Because if you want to rent your home in Des Moines, I live in Des Moines, 3-bedroom, 2-bath home, the going rate for that is probably about $200 a day, depending on what part of the city you're in. However, if I wanted to list my home on Airbnb or VRBO for $1,000 a day, nobody is going to rent it because that's way above market rate. Same thing here. You have to find the market rate for your home. The next thing, again, treat it like a business. You are going to write up a rental agreement between you personally and your business with the stated day rate. Think of it like a hotel. When you check in or make a reservation, you are signing a contract, whether you realize it or not. It is the same thing here. Number three, you have to actually move money from your business account to your personal account. A lot of people forget this, but all tax deductions, they cost money. You either have to spend the money or borrow the money to pay for it. Same thing here. You have to move money from your business account to you personally for the stated rate, however many times you're using it. And number four, honestly, very important, you have to have actual business take place at your home. Think of things like a team party or a holiday party for your business, or maybe you wanted to film a video about how to write off your home office. You would be able to rent it for the day in order to film that. And again, you have to have legitimate business. It can't just be that you decided to stay home and in your PJs and take a Zoom meeting. That doesn't count. It has to be a legitimate business with legitimate business intention. If you can do that, you will for sure be able to take this on your taxes. And the reason why I say you're already doing it, a lot of times business owners, they host business partners for meetings. They have team events, they have networking events at their home. If you're already doing this, you might as well pay yourself and get the deduction for it. Now, the fifth thing that I want you guys to do this year in order to reduce your taxes is I want you to open a retirement account and actually contribute to it. The reason why I say that is you get to contribute money to a retirement account, which grows tax deferred, and you get to deduct it on your tax return this year or from your taxable income. Inside of your account, so let's say you put away $5,000 today, I get to write that off or deduct it right off the top of that $100,000 in the example. That $5,000 will go into the market. It will most likely double or quadruple in the next 20 to 30 years. And when I take it out, it will be worth way more. And if I keep doing that and I compound it, I will be able to save taxes today and grow for the future. Now, the one downside is that you do have to pay taxes on the money when you take it out. However, you do get a tax deduction today. Now, for most business owners to start, I like having them open up what's called a traditional IRA or traditional individual retirement account. There are all types of different accounts, such as Roths, SEPs, 401ks, 403bs. There's all simple IRAs. Let's just keep it simple and start with a traditional IRA. It's super easy to set up. And when I say super easy, if you open up a bank account online, which most of us probably have, you can open up one of these. It allows for a $7,000 tax deduction each year, or at least this year. Every year it does go up, but this is $7,000 for 2025. And most importantly, it is way better than spending money on a car. I am going to circle this like crazy because I wholeheartedly believe in this. Every single year, every single year, I always see or not even tax influencers, just influencers in general, telling people to go out and buy a car, and they went out and bought a car because they Section 179 and bonus depreciated this heavy piece of machinery, and they really don't understand what it is that they're talking about. Now, yes, you can deduct a car on your tax return. That is totally legal and totally fair. However, most people end up buying a car for the tax deduction. And if you saw as you guys saw in the example above, every dollar that you spend on a car, it only saves you roughly 20 to 30 cents. That is a terrible return on investment. That is literally dropping dollars to save dimes. That does not make sense. Now, if you need a car, by all means, go ahead and buy one, but do not buy one with the intent of writing it off. Now, why I like this so much more than spending money on a car is that inherently we only need a few cars, maybe 3 at the most if you're married. And you don't need one every single year. They last a long time. I would much rather you take $7,000 and instead of putting it into a down payment on a car that you can't afford and don't need, that's going to depreciate right when you drive it off the lot, I would much rather have you put that in a retirement account, an asset that you own, and will most likely quadruple by the time that you take it out. That makes way more sense than buying a car that is going to depreciate the second you drive it off the lot. Now, number 6 that I like, that we all like, you want to make sure that you are deducting your travel from your taxable income. When you travel for business, you get to write off things or deduct them like flights, hotels, transportation, meals. And again, that's all meals, even beer. Let's say you want to unwind after a long day of travel for a conference, you can have a beer and write that off. Now, I wouldn't go to the club and get super messed up, but if you want to go to a nice steakhouse and have a beer and steak, go for it. That is completely deductible. Now, most importantly, though, it has to be with business intent. Business has to be the main reason that you are going somewhere. When it is deductible, I'm going to circle this so you guys see this. Business is the main purpose. For example, let's say you want to go to Miami because you live in a state like Iowa in the winter where it's cold, but I just want to go sit on the beach and work on my phone. That's not really tax deductible. There has to be a reason why you went. For example, let's say you went to a conference, or you want to meet a business partner, or you want to check out a location, you want to visit a rental property. There has to be a reason why you are going there. Now, when it is not deductible, again, when it is not deductible, I'm going to circle this here. It can't be when it's the ancillary thing. For example, let's say you're going on a family vacation to Orlando to go to Disney World or Universal Studios. And before everybody gets up, you just happen to bang out some hours on the laptop for an hour or two. And then late at night, you come back and check some emails. Oh, I worked on vacation, therefore I got to deduct it. No, it has to be the main reason why you are going. And again, the last thing that you want to make sure you're maximizing or optimizing are meals. When you eat, it is possible that you can deduct that on your taxes. Now, it is totally possible to do this, right? I go out to lunch or dinner with clients and other prospects all the time. However, it has to be there has to be business being conducted, right? When it's deductible. Again, meal with a client or an associate, partner, right? Now, most importantly, what it is, you have to pay for the entire meal. For example, there's a restaurant in our parking lot. Sometimes I go out to eat with some of our neighbors in the office that happen to be clients. If we go out to the breakfast club to discuss their tax return or their business or whatever it is that they want to talk about, if I only pay for my meal and they pay for their meal, that is a non-deductible expense, meaning it does not lower your taxes. The reason that is that you have to pay for both people. The IRS's logic is that, or where the rule comes from, is that I am going to eat regardless, right? Let's take the meal or the travel example. I'm not always going to go to Miami. I don't have to travel. However, I do have to eat, right? I do have to, otherwise I'm going to die. I'm going to die of starvation. So the IRS says as long as you pay for everybody's meal there, you can write off 50% of the meal. Now, one caveat is meals when traveling alone is deductible. So let's say that I fly to a conference by myself. Obviously, I have to eat, but I wouldn't normally eat at that restaurant because I'm not home. Those are deductible as well. Now, most importantly, when it is not deductible, and I think you guys will understand this, is when you're getting lunch from DoorDash during a normal day. For example, me filming this video, my throat is parched because I've been talking a long time and had to do a ton of takes. I can't therefore order DoorDash to treat myself and say I want to get a soda or a smoothie from somewhere and I get to deduct it because I'm working. That wouldn't count because it's a normal day and I'm just here by myself. Another one is lunch with spouse. Every once in a while, my wife comes on a Friday and we'll go eat lunch out at a restaurant. I cannot write that off or deduct it, even if I pay for both. The reason is she's not a client, we're not talking business, and it's really more like a lunch date at that point. We're not conducting any business, and that's when it's not deductible. But again, if you guys can follow these things, you can deduct your meals with confidence and know you'd survive an IRS audit. Now, if you guys would prefer that we help implement all these strategies, or at least show you exactly and hold your hand to help you save at least $10,000, or be like this client from the beginning, who before working with us was about ready to stroke a check for almost $35,000 and instead ended up paying a little bit over $16,000, was able to save about $18,000. If you want to be like them and have us hold your hand to make sure that you're doing this correctly, make sure you click that link in the description of this video. That way you guys can book a call with us, see if we're a good fit, and we'll help you save $10,000 in taxes. Hopefully we get to see you on that call, and we will see you in the next video.